What actual data sources do quantitative traders even use? Well, that's what we're going to get into today here on the Independent Quant Podcast, episode 6. I am the host and founder of the Independent Quant, Luis, and let's jump right in. What data sources do independent quants or quantitative traders need? Now, before we jump in here, I am not a financial advisor. I'm not providing any financial advice here. This is all for educational purposes. Any trades you take are your own. I will not be getting into any specific market data here today or recommending any symbols. But again, seek professional advice if that's what you are looking for. With that, what type of data do quantitative traders use? Well, that continues to evolve more and more as time has gone on because of the availability of data. When I started getting into machine learning back in 2016, the statistics at that time was that 80% of all the world's data had been generated in the previous 3 years. I don't know whether or not that was true. It sounded true enough to me, as least as I was going through all that training. But if you take that into consideration, there's an immense amount of data out there, and we continuously generate more and more and more. And almost all of that data is fair game for a quantitative trader. But at its core, right, we are trading the markets. So market data is the most important data for us, right? We need to have at the very minimum price, volume, maybe order flow, depending on your strategy. But if we were to say market data for those listeners that are newer to trading usually gets categorized into two levels. And it's not so much categorized, but it's sold by brokers in two levels. Level one data, which is usually suffices for most people's needs. Level one data includes price, volume, and a lot of more, I would say, rudimentary and basic information that you would expect, or a more layman user would expect, to be able to collect out of a platform. Level two data is professional level data. It has typically an order book associated with it. And those are the two big characteristics that at least for sake of this podcast episode, that we're going to really use to distinguish between the two. But that type of data is, I guess, the foundation for all quantitative trading and trading in general. You can get market data numerous ways. The easiest way is by way of your broker's platform. If you have a platform that allows you to code and use quantitative strategies or systematic strategies or algorithmic strategies, then you'll be able to gain access to that market data through your broker's software, and which makes it very convenient, very easy, because you can handle all your data needs within that platform. Now, that gets a lot more complicated as we kind of get a little further along this podcast on the other sources of data, because depending on your broker software, you may not be able to access that other type of data. It depends on how dynamic and robust your broker software is. Some you can programmatically access external data sources, but you're going to have to get familiar with your broker's platform in order to determine that. So we have the market data. Now, what can we do to step that up as far as the next viable data source? That could be fundamental data. Now, I've made some blog posts and videos regarding the difference between trading and investing. Let's just, for sake of this podcast, we're focusing on data sources. The difference, as I describe, between an investor and a trader is an investor cares more about fundamental data and fundamental analysis than a trader does. Fundamental analysis is looking at financial statements, microeconomic indicators, earning reports, corporate actions, sector and industry data. That is what CFAs do, chartered financial analysts. That's usually has been my distinguishing line between a trader and an investor. Well, unfortunately, quantitative trading and systematic trading kind of flipped that on its head, and now you have to disregard that line, because you can access all that data programmatically, and it becomes data that you can use because it is digital. It is available digitally. You can get those using, for example, like the earning reports or the statements from Edgar. That is the interface and the software that the SEC created and manages. You can get Federal Reserve economic data from FRED, F-R-E-D, and you can get, if you're so inclined, Bloomberg terminals are a thing still. They cost $30,000. I checked for a terminal. If that's within your budget, you can get that, and it allows you to get a lot more fundamental data all in one location. But you can take fundamental data as a trader, as a quantitative trader specifically, not as a discretionary trader. Our last episode, we made the distinction in between the two. We're able to now take fundamental data and merge it with that market data that we just discussed to find signals. So that's another layer of data that we can use, is that fundamental data. And something that's moving on to now to the third type of data. This is something that has really taken off. I'd say in more recent years, the larger funds have probably been doing it for several decades, but now it's something that we as smaller traders are able to make use of, is alternative data. Alternative data, it's a horrible name, but what else are you going to call it? It's any of the data that is not market data or fundamental data. It is data that may not be financial at all. For example, there's sentiment data, social media, satellite data. One of the things like social media sentiment is the social media companies make money by allowing anyone, it doesn't have to be a large corporation or a business. No, you and I can go get an account and market on one of these social media channels, and you can gain access to people's posts. You may not gain access to who made the post, but you can gain access to the aggregate data. And what you're able to do that is collect all that data and identify what the sentiment is. So you can query social media posts, social media activity to just see what the reaction may have been to some news event and potentially get a signal out of it. There are large firms out there using satellite imagery. That is seeing, hey, how many trucks are coming and going from a warehouse? How many Connex boxes are those shipping containers are on these ships as they're moving from port A to port B? How many are being left at each one of these docks? They can query all that and have those be data points to feed their algorithmic strategies. Then from there, you can get back to more, common data, which is web scraping. You can programmatically have your algorithm go out to specific websites and scrape. That means pretty much read. That's how a program reads a website. Can't read like a human, obviously. So it's called web scraping. It goes through the website and collects information off of that website that now you can wrangle, shape, and maybe get sentiment data out of it, get some other signals out of it by mixing it with any of the other data that we've discussed so far. So web scraping is something that becomes possible. Another one is credit card transaction data. So this is now going back to financial data. You can start getting into people's personal finances, and this is all in aggregate, but it's looking at where are the opportunities. Are people defaulting in something? Are they spending more in one specific type of industry? Then maybe you go to that industry and see what symbols are moving within that industry. That may be a signal. So another way to just use an alternative data sources. Now, alternative data, the challenge with it is that depending on the source, most of it that I've seen is not free. It does require a substantial investment. I have not used alternative data. It's not part of my trading strategy. It's not something that I've researched for myself. Just in my studies of quantitative trading and just doing this for as long as I have, I know that it's something that's become very commonplace, but I don't have any firsthand knowledge as to what the actual cost of using that type of data is. Now, I mentioned sentiment data with regards to social media, But a fourth type of data source is the news itself. I kind of hinted at it before, but the news is available for us to be able to, pretty much process, so that is available by any breaking news feeds, using sentiment scores, using an AI agent, or looking at economic calendars. So news, as traders, for those that are newer to the podcast, as traders, we call news two different things, I would say. The first one is what everyone calls the news, which is what's on the newspapers, what's on TV. Sure, that is the news. But news for us as traders is also announcements. That's the Federal Reserve Board making announcements, reports that are coming out, where you can find these on economic calendars. So they're typically reports of macroeconomic events. We refer to that as news as well. For myself, I typically am trained to stay out of the markets as that type of news is coming out. However, if you're running an algorithm now or have a system to approach both the types of news, be that the news that's in newspapers or the news that's coming from macroeconomic data via reports, you can develop a system to react or take a certain type of action depending on what the news is or what the expectation was of that news, what the difference between that was, and how you anticipate the market will react because of that difference. So news and sentiment data related on the news is also a big factor that can be used for algorithmic trading. The last one I'm going to cover here is order flow and execution data. So at the very beginning of the podcast, we talked about market data, level one data being data that has that very basic information. It's plentiful. It has a lot of information within it, but it lacks order flow and execution data. And what does that mean? So if we go all the way back over 100 years, early 90s, when we started trading, day traders became more of a thing. Intraday traders and end of day traders, they would trade the tape, and the tape was literally a sheet of paper like tape with the days open, high, close, open, high, low, and close all printed on it for the various symbols. They could look into what the volume and the activity was at different price levels, and that was the tape. Today, that we call that order book and order flow. It is something that you could add on to your broker's software package. Typically, it is level 2 is typically not free. However, I can say that for myself, this is not an endorsement or a recommendation. This podcast is not sponsored by Charles Schwab, but I am a Charles Schwab client. I've been using Thinkorswim since I want to say about 7-8 years now, back when it was owned by TD Ameritrade. But one of the things that had me stay with TD Ameritrade at that time was they provided level 2 data free of charge, and really all data free of charge, so provided that you maintain an account with them, which, aside from just the financial commitment I've had and why I didn't leave Charles Schwab when he bought it out, is one of the reasons that I stayed. All the other platforms that I've had before do charge for data, period, be that level 1 or level 2. Level 2 is a lot pricier. It's going to depend on your broker, how much you'll pay for that. But once you decide that, yes, this is going to be something that is important for you and is key for your strategy, you can pay for level 2 data, and it'll give you access to the order book and order flow. What are those things? So both the order book and order flow tell us how much activity was happening at each price point, right? So how many orders were placed, how many of those orders were filled, how many are left outstanding. That is the order book and order flow. And with that, traders can do a lot, but for sake of this podcast and keeping it simple, it shows you where the activity is. It lets you find where support and resistance are. If you're newer to trader, supporting and resistance is the concept from technical analysis, which is the concept that price typically, if it goes down to a certain point, it brings the buyers out, which causes it to rally. And then when it hits another price point, it motivates sellers to come out. It brings the sellers out, which causes them to sell and drive the price down. Now, those rally and shortage points are that's support and resistance. That's, there's the argument to be made that at that price point, the stock or the symbol won't go down below that without excessive pressure because it's bringing out so much activity. You can see where those levels are at if you have level 2 data because you can plot that out. It becomes very transparent to you where the market activity is, where the big players are, where the big orders are, and it really helps inform your data. Many professional traders out there, level 2 is the source that you want to be using if you're going to be doing any type of trading. I'm not trained on level 2 data. I've never had to trade it, deal with it, even though I have access to it via the platform I just mentioned. It's not been something that I've incorporated into my trading, though as I continue building my trade desk, that is something that I am going to explore more as I use more algorithmic strategies. So we covered there 5 different data sources from market data, fundamental data, alternative data sources, news and sentiment, and finally order book and order flow. That's a lot to digest there. If you're still relatively new to quantitative trading and systematic trading, head on over to Independent Quant, sign up for our newsletter, and just start getting a little smarter on all these topics that I'm talking about. I try to bring it down to as a newbie level as I can so that my novice traders out there and those that are looking to venture into trading can understand and have a way into what I think is a great profession and a great way to take hold and manage your own money. But if you want to learn some more, we do have a mini course available, and it gets into more as to what quantitative trading is. But at the very least, just head on over, sign up for our newsletter, and I so much look forward to seeing you at the next podcast and engaging with you in the near future. Until then, keep it green. This is Luis, out.